Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Sunday, June 4th, 2023. I hope you're doing well. I really appreciate you coming and watching my week in review. And what a great week we had in the market. Big, strong week. Friday, we had a bit of a rotation from tech, it looks like, into some of the industrial stocks in the Dow Jones. So anyway, everything's looking good. Like I said, I appreciate you being here. I hope you're going to learn something today. Let me tell you about the format for today's podcast. First of all, we are going to run the U.S. legal disclaimer. Secondly, we are going to come back. We are going to take a look at all the trades I made last week. We're going to talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade going forward. After that, we are going to talk a little bit about trader psychology, always the most important skill in trading, the ability to create a plan and then follow your plan without letting your gains or losses amplify your emotions and get you off of your trading process. It's always good for me to teach this. It helps me, and I hope it helps you as well. After that, I have gone down through my master watch list, looking for potential trades next week, both on the daily charts and the weekly charts. Generally, during this podcast, when I look for these trades, they are not where they need to be yet. They either need to go higher or they need to go lower in order for me to get interested. You know, my basic trading strategy is looking for rejections. If I'm long, is looking for some type of rejections to the downside, whether that's the 200-day moving average, 250-day moving average, 300-day moving average, 30 RSI. But I like to see the market test these levels and reject these levels, enter the trade, position size correctly, giving me a good risk to reward ratio if I'm long, and having a process to follow to the upside if I am right. I like to play both offense and defense in trading, just like with any great sports team. Position sizing correctly based upon the current market volatility is very important. Having an emergency stop in case you are completely wrong, having an end of day stop or an end of week stop based upon a level, kind of a line in the sand. And if you're wrong, just getting out quickly with the small loss. So that's the defensive part. Position sizing, emergency stops, end of day stops. The offensive part is to the upside, taking partial profits when it moves a certain amount from the previous bar's close. If you get up to a trailing stop level, which is 1.5 ATRs above my entry, then I go into trailing stop mode to tighten up that stop. So there are a lot of things in trading, a lot of components in trading that you have to look at both offensively and defensively. And when I go through the charts, I have identified some both on the daily and the weekly charts that I'm looking for next week. But as I mentioned, they are not there yet. I want to see some kind of rejection. If they get there, and it looks good, on multiple time frames, and there's a confluence combination of indicators lining up, I will definitely consider taking the trade. So we'll go through the dailies, what I've looked for on the dailies, and also for the weeklies. And by the way, weekly bars close on Friday, so I would make my decision on the Friday close. Currently, I have weeklies and I have monthly trades only, which is kind of strange. I don't have any daily trades, but you know, the market at this point, especially the NASDAQ, so high that it doesn't really allow me to enter a trade. We're getting up to some nosebleed levels looking for a pullback, but there are some things both on the there are some on the weekly charts specifically that I'm looking for. So hopefully this will help you. Before we get started, I have to run the U.S. legal disclaimer, so I will be back in about 40 seconds. Hang tight. Thank you so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding through that with me. And by the way, doing this podcast on Sunday, I usually do it on Saturday, but I've been traveling. So doing it a day late, but kind of interesting to get out of town. Took a little bit of a road trip and enjoying that. So, all right, well, let's get started. By the way, I am going to show you the process that I use. I do have quite a few rules that I use. And if you're new to this channel, you may think, boy, those sound like complicated rules, but they really aren't. But just want to point out here, and I'll talk more about it at the end of the podcast, but I do teach private one-on-one lessons in the evening time. I love to teach. I teach the one-on-one because I think it's the best way to learn anything is to have a one-on-one mentor or teacher teaching you whatever skill it is. And in my course, it's a 15-hour course, 5 sessions. Each session is 3 hours, and I teach you all 5 of the trading approaches that I use step by step. And when you're done, you're going to be a much better trader. So if you are interested, my email is in the link of this YouTube video. Just reach out to me, but I will talk more about it at the end of the podcast. So let's get started on Russell 2000. All right, I bought the Russell here based upon a weekly rejection of the 300-day moving average. This is the orange line. Remember when I said I was looking for some kind of rejection to the downside, either the 200, the 250, the 300? Well, this is where I bought it right here when during the week it went below, closed back above, showing there were no more sellers back at this level. And at this point, I have to position size correctly. So what I do is I take 1% of my total capital, I divide it by the value of the 2 ATR. That shows me how many shares to buy. Now, I also then right here, ATR is 15.998. Back here it was different, but when I bought it here, whatever the 2 ATR was below, I placed it below. This is the pink line, fuchsia line down here below. That was 2 ATRs below my entry. If it ever got there, I immediately get out and I lose 1% of my total capital, regardless of what the percentage move is. So that's the emergency stop. End of week stop would simply be a close below the 300 moving average, and it never has done that. Now, in addition to that, I always place a trailing stop level 1.5 ATRs above my entry. When I get there, if I then have a close below a previous bar's low, then I sell half the position. In addition to that, when and if it moves up, oh, sorry, phone call. If it ever moves up 0.45 ATRs, right now 0.45 is 3.6. If it moves up the value of the 0.45 from the previous bar's close, I take 10% of the profits off. So I like to sell into strength. So think about what we're doing here. We're looking for a rejection of a level. Okay, we position size correctly, we place our emergency stop, and then we have our end of bar stop. Most of the time, 95% of the time, your loss is going to just be a smaller end of bar stop. 5% of the time, yes, you will hit your emergency stop, but it doesn't happen very often. That's the defensive part. Taking profits on the upside while you have them, just partials. That's the offensive part. Getting to a trailing stop level and then having a close below previous bar's low, that is also considered defensive. So rejection of the 300-day moving average, entered here at 167.19, moved up, took profits, moved up, took profits, moved up, took profits, got to trailing stop level, then had a close below a previous bar's low. I sold the remaining half of the remaining shares, and it was approximately a gain of 6.24%. Keeping in mind that my end of bar stop is a close below the 300-day moving average. Started to come down there, didn't get there. Then we had another huge upswing where I took more profits, more profits, more profits. Then it came down. I thought, oh, I think it's going to close below the 300. I'm going to have to get out with the remaining shares. But it has held, it has held, it has held. Big up week last week on IWM. And so far, the remaining shares I have in this particular trade up 7.9%. So pretty nice trade with a very good risk to reward ratio. And that's the key. XLF. Let's take a look at XLF. Okay, I bought here the 24th of March. Why did I buy it? Well, rejection of the 250-day moving average, or a bounce, excuse me. Came down, bounced, very close to the moving average, placed my trade, entered the trade, position size, placed my emergency stop 2 ATRs below, and then what is my end of week stop? Well, I took it based upon the bounce at the 250. If it closed under the 250, I would get out, to the, now it moved up the next week, took some partial profits. Next week, nothing, moved up again, took some partial profits. You see the orange line? This is my trailing stop level, which means now if I have a close below a previous bar's low, I will get out. Went down below the low, but closed above, went down below the low, closed above, still holding the 250-day moving average, and we have not had a close below a previous bar's low. This particular trade doing very well, up 6.18%. So not bad. All right, Netflix. Right, Netflix is a short that I took on Friday. Remember, bars close on Friday. I shorted it here at 404.65 with a rejection of the 200-week moving average. Now, this is a short, so I position size the same way. I place my emergency stop 2 ATRs above. My end of week stop will simply be a close above the 200-week moving average. If it closes above, I'm just simply out. I place my 1.5 ATR trailing stop level below, which in this case, because it's short, means if it gets down to this level, then if I have a close above a previous bar's high, I will take half of the position off. Now, in addition to the rejection of the 200-week moving average here, you see the dotted line, my entry line. Let's look at the higher time frame. Higher time frame, do you see how we also rejected the 50-month moving average? That's a combination confluence on multiple time frames that a level above has been rejected. On the weekly, rejection of the 200. On the monthly, so far, rejection of the 50. So I like to look for multiple levels of rejection on multiple time frames. So do I know this is going to go down? Absolutely not. I just absolutely do not know, especially with this strong of a market. But the technicals are showing me that I did reject the 200-week moving average, and it gives me a good risk to reward ratio. That's the main thing. Again, if it closes over the 200, I will just get out, most likely with a small loss. Up here, I have things covered in case we have a blast off here. Then if it gets to this level, I'm just going to lose 1% of my capital, which, it's not fun to lose 1%, but it's not that big a deal, right? It's not really going to hurt your trading account or blow up your trading account. So let's take a look here. So I got in. Let's see. So this trade currently in the money about 0.99%, so almost a percent. So again, rejection of the 200 on the weekly, rejection of the 50 on the monthly, multiple levels of resistance to the upside, and again, just a good risk to reward ratio. If it just closes even 1 penny above that 200, I am out. Now, average true, the 0.45 ATR is $12.14, which means right now the current price is 447. If I take 447 cents minus 12.14 to the downside, then I will take a partial profit. Okay. And again, I know this can kind of sound complicated, these decimals and these terms and so forth and so on, but it's really not that hard. But in the time I have allotted for this podcast each week, I can't really get into the nitty gritty of everything. But if you do decide to take my course, I promise I will teach you everything we go through, and we do all sorts of simulation trades, and it's a serious course, right? 3 hours per session. So we really get into it. And it's very important to me that my students succeed and know this like the back of their hands. So currently, new trade here, up 0.99%. XLRE. All right. I did enter XLRE last Friday at 36.32. Now, I didn't reject any 300s, 250s, 200. Why did I take this trade? Well, this is another one of the trading approaches that I use. It's called a higher low V2. Higher low V2 requirement, you have to close below the -1 ATR channel, which is the green line. You have to rally into the value zone. You have to pull back, and then this is a higher low V2. Bar 1, bar 2 goes below the low of bar 1. Bar 3 closes above the close of bar 1's close. And you see how this higher low, this low here is higher than this low? This could be the beginning of a nice, strong move up. Now, I don't have a 200, 250, 300 for my stop. I have my emergency stop down here, which again is just 2 ATRs below my entry point. But my end of week stop will be halfway if we have a close below halfway of the washout bar, or in other words, last week's bar. So you can see the line that I drew here, that's halfway. It's likely that it could come back and test this halfway, but if it closes below, I am out for a small loss. But if it stays above, then I have a chance for a move up. Higher lows tend to have longer up legs. Lower lows tend to do this. They go low, they bounce, and they come back down. So this particular trade on the weekly did take this trade, and it is currently up 1.28%. So all the weekly trades on the stocks did well. This one, not so hot tamale, but again, this is a good teaching point here. I did buy VIX back on the 19th of May when we went under 30, over 30. 30 RSI level, a lot of the time will hold. And in addition to that, we had a double bottom with the bullish divergence. Here's your low with deep red MACD bars. We have a rally into green. Then we came back. See how this is lower than this low, but you see how there's no red bars? That's called the double bottom bullish divergence. I learned this from studying one-on-one with Dr. Alexander Elder, and in his opinion, this is one of the strongest technical patterns in trading, but it doesn't always work. So I bought this with the rejection of the 30 RSI. Next week, it held the 30 RSI. This week, big down move in the VIX. You can see right now, 2681 is the RSI. So did it close under 30? Yes, clearly it closed under 30. So I had to get out for a loss of 11.02%, which sounds like a ton, but did I lose 11.02% of my capital? Absolutely not, because here is my emergency stop. And remember, had it gotten to my emergency stop, how much would I have lost? 1% of my total capital. So this got down about halfway to the emergency stop. So I lost 0.5% of my capital on this, even though the percentage move was minus 11.02. So, I have people that email me and say, Greg, okay, you lost 14% on this trade. Does that mean you lost 14% of your money? No, absolutely not. Again, because of the formula that I use for position sizing, in the worst case scenario, had it gotten to my emergency stop, I would have lost 1% of my capital. And as you can see, clearly we were not even close to the emergency stop. So it was about a 0.45% loss. So anyway, market very strong. These VIX here at historic levels. Will I be interested in buying VIX again? Yes, I will. But the only move at this point to buy VIX is if it closes back above the 30 RSI next week, then I will consider it. Okay. So that is VIX. And then Love. I like to trade multiple time frames, day trade, daily charts, weekly charts, and monthly charts as well. And I did enter a trade on Love, which is Southwest Airlines, at the end, what are we in? June? May. So May, these are all monthly bars. Do you see how we went below the 200-month moving average and then we closed back above it? Well, that's my line in the sand. So I did enter last week at 29.60 with the intra-month rejection of the 200-day moving average. Again, I position size by taking 1% of my capital, dividing it by the 2 ATR value that shows me how many shares to buy. Then I place my emergency stop 2 ATRs below, and if it got down there, I would lose again 1% of my capital. My end of month stop is simply a close below the 200. So if it closes below the 200, I will just go ahead and get out of the trade, most likely for a small loss. I mean, even in the worst case scenario, if I hit my emergency stop, I only lose 1%. Okay. And then orange line up here, this is my 1.5 ATR trailing stop level above. If it gets there, then I will go into trailing stop mode, which means if I have in the future after that, after it reaches that, if I have a close below a previous bar's low, I will just go ahead and go into trailing stop mode, which means if I have a close below a previous bar's low, I will exit half. So this particular trade doing pretty well so far, but I could be in this trade for months and months and months, right? Up 1.63%. So hope that helps. These are the current trades. So IWM up 7.9%, XLF up 6.18%, Netflix on the weekly up 0.99%, XLRE up 1.28%, VIX, the only stinker in the bunch, down 11.02%, and on Love on the monthly up 1.6%. All right, let's talk a little bit about trading psychology. Again, everyone, this is what trading is all about. And that's why I like to talk about it. Hope it's helpful for you. It is always helpful for me. This is from Akil Stokes, great channel on Twitter. You can follow Akil at Akil Stokes, RTM. He's quoting Peter Brandt, one of the market wizards. Trading quote of the day: if there's one metric that really affects performance long term, it's small losses. Developing an approach that will keep loss size down, that is the single most important influencer of long term trading performance, by Peter Brandt. And then Akil replies to that: most of my earlier trading mistakes came because I would try to avoid losses, or losses would affect my mindset. However, once I learned to accept them and keep them small, the losses, I stopped getting emotional and I stopped making errors. When you go into a drawdown, it affects so many things. It makes you make decisions that are usually the wrong ones because you're trying to get it back. I have gone through this. I know of what I speak, and if I could get through to you how important keeping your losses is, I really want to try to do that for a couple reasons. One, in the math, in the calculus of trading, you can have large wins, you can have small wins, you can have break-even trades, and you can have small losses. All of these are acceptable, but what will really destroy your trading and your account are large losses. So just that alone is why you need to keep losses small. And that's why I've shown you I have an emergency stop loss, I have an end of day stop loss or an end of bar stop loss. And even if I hit my emergency stop, it's fine. It's only a 1% loss, but 95% of the time it's going to be much smaller than 1%. So I'm keeping losses small. That by itself is important. But the second part that's so important is the mindset and the psychology of having big losses. That messes everything off. That gets you out of your groove. That's what causes you to make bad decisions, doubling up, tripling up, trying to make it back. It's no good, everyone. I have been there. So this is so important for multiple reasons. One, because you don't want to have big drawdowns in your account. And number two, that it affects you mentally and makes you trade poorly. So if I can imbue to you anything today, it is keep those losses small. And that's why you need to have that line in the sand, whether it's halfway of the washout bar or close below halfway of the washout bar. even a penny close below the 200-day moving average. You have to follow your process. It's so important. I've been trading for 28 years, everyone, and you know how it feels when you're in a groove. You take a small loss, okay, it doesn't hurt that much. You get on with it and you forget about it. But if you have a big loss that you're trying to come back from, it is very, very difficult. So if you are for some reason in that position right now, just start over. Start trading correctly. And if I can help you, let me know, because it can be life-changing for some people if they get on the wrong side of things. So one more time, if there's one metric that really affects performance long-term, it's small losses. Developing an approach that will keep loss sizes down. That is the single most important influencer of long-term trading approach by Peter Brand. But this is the key. Develop an approach that will keep loss sizes down. And that's what I do. That's what I teach. If I can help you with that, please let me know. Okay. All right. Let's go over to potential trades for next week. We'll first start with the daily. And again, because of this market rally right now, not a lot of setups. So next week, in order for me to get interested on any of these three potential daily trades, it has to come back down. So this is on AGQ. Okay, I have been looking for AGQ to come down to this 200-day moving average. This is the black line for a while now. Almost got it here, but it didn't bounce or reject, unfortunately, because I would have taken the trade, but it didn't get there, so I have to let the trade come to me. Next week, if and only if AGQ bounces at the 200-day moving average and gives me a good risk to reward ratio, or has an intra-day rejection, meaning it goes below and then closes back above, then I will potentially take AGQ. And if it does, and it offers me a good risk to reward ratio based upon the 200-day moving average, I will consider taking the trade. If I'll position size correctly, I'll place my emergency stops 2 ATR below. If I have a close below the 200-day moving average, I will simply get out. Now, I have the black line here, 200-day moving average. I drew the green line here. Let's look at the higher time frame. Let's look at the weekly time frame. Is there any support? Here's the green line. This is the 200 on the daily. Is there any support on the weekly? Well, yeah. Well, for one, we're inside the value zone. The value zone's between this green line and this green line. That by itself is good. Then we have support of the -1 ATR channel. We have support of the 50-week moving average. So it makes sense on the higher time frame that it's in a good location. But I still need the entry trigger, which is the rejection of the 200-day moving average. If it just takes off, great. But if it comes down and rejects that 200-day moving average and gives me a good risk to reward ratio, then I will definitely consider taking the trade. Caterpillar had a huge day up on Caterpillar. Now, it closed below the 200 and above the 200. Do I want to buy here? No. And why? Well, because my risk is really big. If it heads back down, look how far below the 200-day moving average is. So two examples or two potentials on this particular trade. The first one, and the obvious one, would be that if it came down, bounced at the 200 or rejected the 200, giving me a better risk to reward ratio. That makes a lot of sense, and that's the orthodox traditional way of trading. Now, little bit of a deviation here that I am considering on this bar. Obviously, this was a very large up bar. Now, from a Fibonacci standpoint, if we move back, and I don't know if we are or not, but for some reason, if we do move back and we get to halfway of this bar, the bottom to the top, this is about halfway, there will be some inherent support at this level. So in this particular case, which is kind of a one-off, again, if it rejects the 200, sure, and gives me a good risk reward ratio, consider taking the trade. But if we get back to this halfway point and hold steady there, I will consider getting long there as well. Because from here to here is a decent risk to reward ratio. But in conjunction with that, the high to the low moving back to halfway this would make an appropriate place to enter because there is support, Fibonacci support between halfway of the low and the high. Hope that makes sense. And also we have the previous high here, which was resistance. Now it's going to act as support. So the support here at halfway of the bar, move back to halfway of the bar, and also supported this previous resistance, which is now support. And in addition to that, it would give me a better risk to reward ratio. Now, if it keeps moving up, great. Any of those of you that have Caterpillar, happy for you. But for me to get interested in this trade, either a pullback rejection of the 200 or secondarily move back to halfway, which accomplishes two things. It gives me a better price. It gives me a better risk to reward ratio. We should have support at this previous, what was previous resistance, and we're halfway of the bar. So this is what I'm looking for. But if and only if next week it rejects the 200 or it finds support at the halfway mark. Coca-Cola. Coca-Cola also had a big update. You know, Coca-Cola, these defensive stocks, consumer defensive stocks, Philip Morris, Coca-Cola, really got beat up they have gotten beat up over the last month because all the money's been rotating into NASDAQ, but they sprang to life a little bit on Friday. Now, this is a lower low close back above the 200. We made a low here, obviously low. Then we had to close under, close back over. Well, this, you could take this, I could have taken this trade on Friday, but I didn't because it came from a lower low. Higher low rejections of the 200 are always better. So next week, if we come back, and this one's more likely than Caterpillar, but if this one comes back, bounces at the 200, or again goes under and closes back over, then I will have a higher low close back above the 200, and that's where I'll get interested. All right, let's take a look here. So I drew the line at the 200-day moving average. Let's see what that looks like on the higher time frame in the value zone. So it's decent. It makes decent sense on the higher time frame. So again, next week, if we come back, bounce or intraday rejection of the 200, I would consider taking the trade. So just a quick recap, AGQ, if we come back down, reject the 200, I'll consider taking the trade. Caterpillar, if we come back down, reject the 200 or hold steady at the halfway of Friday's large bar, I'll consider taking that. And then Coca-Cola, if we come back, back test the 200, I'll consider that as well. All right, let's head over to the weekly charts, see if anything's going on over there. All right, Johnson & Johnson. Okay, well, you probably guessed it. What is the major level of support below? That's the 200-day moving average. It's the black line. So this is what I'm looking for. Let the trade come to you, everyone. If we come back down, reject that 200, I will be interested in taking the trade. If it doesn't, I'm just going to forget about it. I want to see a rejection of this key level. I drew the line here. Look at the higher time frame. Has support of the 50 EMA, 50 SMA below. So that looks fairly decent. But if and only if we come down, we bounce, or intra-week reject at the 200, then I'm not going to take the trade. But if we do, I will consider it. Once it, the levels down here is where it bounced last time. Doesn't mean it has to happen again, but if it gets closer to this level, it might do it again. And the 200-week moving average gives me a good reference point. It gives me good context. It gives me a good risk to reward ratio. Again, let the trade come to you. Let the trade come to the level that you are interested in. Rio, okay, same thing. Not that hard, everyone. The hard part is when you're in the trade, following your process, but getting in the trade is very clear. This level makes sense, the 200-week moving average. If we look at the monthly, really good on this one. We're inside this big bar. We have the levels of the 50 EMA and the 50 SMA here as supporting levels on the higher time frame, which is the monthly. But on the weekly, if we get down to the 200 bounce and or intra-week reject with a good risk to reward ratio, that's where I would consider getting long RIO. Silver. All right, well, here we go again. Here's silver SLV on the weekly. Very simple, 200-week moving average makes sense here. If we bounce or inter-week reject, then I will consider taking this trade. It will be if it does, it will be a higher low rejection of the 200. Here we had to close under, close over the 200, and this one went, but now it's pulling back. If it bounces or intra-week rejects here, we'll have a higher low rejection of the 200, and higher lows tend to be able to have those nice, easy up moves. Here, a lower low did it, but it's not as likely. Okay, and then last but not least, UNG. UNG is interesting trade here because, again, this is another approach that I teach in my trading, which is called the double bottom bullish divergence. Look here, we have a low here with deep red MACD bars. Then we rallied into some green. Now, are we lower here than we were here? We certainly are. But do you see how we have no red bars here? This is called a double bottom with the bullish divergence. Also, at this low, we were at the third, about 3.5 ATR level. Now we are lower. We're only a second ATR level. That is called an ATR divergence. If you look at the RSI at this low, we were way under 30. Now we are lower here and we're over 30. So that's the trifecta of divergences. Double bottom bullish divergence, double bottom ATR divergence, double bottom RSI divergence, but I just need, this is all good. Big picture, structure wise, this is all good, but I still need a signal to get into the trade. Well, 200, 250, 300, all up here. So what would be my level to key off of? My level to key off would be a 30 RSI. If we went under 30, over 30, or bounced at the 30, that would be my level that shows me that a level below got rejected. Doesn't mean it has to work, but it's more likely to work, and it gives me, again, a good risk to reward ratio. So really interested in this UNG trade. Obviously very, very low. I think some of us would expect some kind of bounce, but I can't anticipate it. I have to let the market show me that it's going to reject. So real quick recap on the weekly bars. Johnson & Johnson looking for a rejection of the 200-week moving average. Rio, where did my possible rejection of the 200-week moving average. Silver, rejection of the 200, and UNG, rejection of the 30 RSI. Now, it's possible that both on the daily and the weekly that all of these trades could trigger next week. So does that mean I'm going to take them all? No. I'm only going to take the one. I'm going to take one per day or one per week, whatever looks the best, whatever has the best confluences of indicators and risk to reward ratios on multiple time frames. That's how I will narrow it down. All right. So, at the beginning of the podcast, I mentioned I do teach private one-on-one lessons. I love to teach everyone. I love to teach trading. I'm good at it. I'm very patient. I've taught people from all over the world, from absolute beginners to hedge fund managers. So, if you decide that you want to learn with me, I think you're making a good decision. Like I said, I teach a 15-hour course, 5 sessions. Each session's 3 hours. We do all sorts of simulations. I throw a lot of curveballs at you, and you're gonna learn a lot. It does cost $1,750, but it is worth every penny for the time and the attention and the experience of what I'm going to teach you. So if you're interested, just send me an email. Email is in the link of the description. I will get back to you and I'll say, hey, thanks for saying hi. Let's set up a Skype call. The Skype call is free. It is not a sales call. I just want to learn more about you, your trading goals, your trading challenges, and it's a great time for you to ask me any questions about the course. All right, so feel free to do that, and I look forward to speaking to you. If you like today's podcast, I would really appreciate it if you could hit the thumbs up button. It does help to build the channel, lets YouTube know that there's some valuable content. So if you learn anything today, I'd appreciate a quick like. If you like online courses, I have a great online course available at udemy.com. In this course, I teach you the deep dip buy stock trading strategy. I teach you step by step. And the best part about this course is very affordable, between $12 and $15. But don't let the low price fool you, because there is so much content in that course. There's 26 videos, there's 15 study guides, 9.5 hours of video, and I teach you step by step how to teach the deep dip buy stock trading strategy. A lot of the trades that I showed you today are exactly that. And then last but not least, please try to go out and do something nice for someone today. It would make the world a better place for all of us if we all did one nice thing for another human being. It would also be great if you could go out and do one nice thing for an animal. They appreciate acts of kindness just like we do. But I hope today was helpful, everyone. If you have any comments or questions, please leave them in the comments section. I'll do my best to get back to them. And I just hope you have a great week. And last thing I want to leave you with is be a little careful in the market. We've had this huge move up, especially in the NASDAQ. You don't want to get FOMO, which is fear of missing out. We're at extended nosebleed levels up here. It could certainly go higher, but if you're buying up here, make sure you have a tight stop, because things that go up come down. But just felt strongly that I want to tell you that. And don't get caught up in all the hype. Let the trade come to a level that you want. No one's forcing you to take the trade. Wait for it to get the level that you want. All right. Thanks a lot, everyone. Hope you have a good rest of your weekend. Have a good trading week. Be careful. Follow your rules. Use proper trader psychology. Stick with your process. And God willing, I will see you and talk to you next week. And on the way out here, I have to run the U.S. legal disclaimer. Thanks so much, everyone. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.